Today, we are diving into one of the biggest questions in all of finance, something that's really at the core of managing risk. It sounds like a simple question, doesn't it? But trying to figure out the real probability of a loss, well, that's a whole different ballgame. We're not just taking a wild guess here. We're using some pretty sophisticated math to model all kinds of financial risks, like big swings in stock prices or sudden changes in interest rates. And today, we're going to pull back the curtain and show you exactly how it's done. So to get our heads around this, we're actually going to forget about the stock market for a minute. Instead, we're going to look at something way simpler, a pair of dice. And you might be thinking, okay, what on earth does rolling dice have to do with my portfolio? Well, you'd be surprised. The way we map out every single possible outcome with dice is almost exactly the same process we use to model risk in the market. Okay, so check this out. With 2 dice, you've got exactly 36 possible combinations. This table lays it all out for us. Every sum you can get from a 2 all the way up to a 12, and it shows how often each one can happen, that's its frequency, and of course its exact probability. So rolling a 2, that can only happen one way, snake eyes, so the probability is just 1 in 36. But a 7, you can roll a 7 in 6 different ways, which makes it the most likely outcome by far. See what we just did? We've basically created a complete map of possibilities. And when we turn that table into a picture, like this bar chart, you see this really distinct shape emerge. You can't miss that peak right there at 7. And you can see how the chances just taper off as you get to the really high or really low numbers. This shape, this picture, has a name. It's called a probability distribution. And it is an absolutely fundamental tool for understanding anything that's random, whether it's dice or stock prices. So, how do we jump from a casino table to Wall Street? We take this exact same idea of mapping out probabilities and we just apply it to financial assets. The main difference, really, is that a stock's price isn't like a dice roll. It can be any value in a range, not just a whole number. It's what we call a continuous variable. And that brings us to a really important idea, the probability density function, or PDF. The easiest way to think about it is that it's just the smooth, curvy version of our dice chart. It shows us the relative chance of an asset's price landing at any specific point. The higher the curve, you guessed it, the more likely that price is. Now, if the PDF tells us the chance of one specific outcome, the cumulative distribution function, or CDF, does something a little different. It adds everything up. The CDF tells us the total probability of an outcome being less than or equal to some value. So it helps us answer questions like, what are the odds that my stock will be worth $50 or less? Now, in the world of finance, the go-to tool for this kind of modeling is almost always the normal distribution. You've definitely seen it before. It's the famous bell curve, and it's used everywhere because, it does a pretty decent job of approximating how a lot of financial things behave. But, and believe me, this is a huge but, it has a massive critical flaw. And this is where our story becomes a tale of 2 models. On one side, you have the good old normal distribution. It's common, it's easy to work with, but its flaws can lead you to some seriously wrong conclusions about the risk you're taking. And that's why we really, really need something better. So here's the problem, the big issue with the bell curve in finance. It's perfectly symmetrical, right? And its tails stretch out forever, to positive infinity and to negative infinity. And that means the model actually allows for the possibility of an asset having a negative price, which is just impossible. A stock can drop to 0, sure, but it can never, ever be worth less than 0. So what's the fix? Well, the solution is to use a more sophisticated and, frankly, more realistic model. It's called the Lognormal Distribution. It's specifically designed to handle things that can't go negative, which makes it a much, much better fit for asset prices. And right here, you can see the difference clear as day. The normal model is symmetrical, it treats massive gains and massive losses as being equally likely, and it has that impossible negative zone. The log-normal model, though, it's different. It has a hard floor right at 0, and it's skewed. This actually reflects reality way better, because while your potential gains are theoretically infinite, your potential loss is always capped at 100% of what you invested. So what's the bottom line? What does all this theory actually mean for your money? Let's put these 2 models head-to-head with a real-world example and see just how much of a difference the right model can make when you're trying to figure out your risk. All right, here's our scenario. Imagine we have a stock that costs $100. And it's got a pretty high volatility of 50%, which just means its price tends to swing around a lot. What we want to figure out is our 90% value at risk, or VAR. So what is VAR anyway? Put simply, the 90% VAR tells us the most money we should expect to lose 9 times out of 10. But here's the important part. It also means there's a 10% chance, a 1 in 10 chance, that our losses could actually be worse than that number. It's a really key way of putting a specific dollar amount on your potential risk. Okay, time to crunch the numbers. First up, we're going to use that flawed normal distribution model. Remember, this is the one that thinks our stock price can go into negative territory. Let's see what it tells us. So according to the normal model, our 90% VAR is $64. That means there's a 10% chance we could lose more than $64 on our $100 investment. Yikes, that's a pretty serious risk. But wait a minute, we already know that model has a big problem, right? So what happens when we run the calculation again, but this time using the much more realistic log-normal model, the one that knows a stock can't be worth less than 0? The result? A potential loss of $47. Now that is a massive difference. Just by using a model that actually reflects how stocks behave in the real world, our calculated risk drops a lot. The log-normal model gives us a much more reasonable picture because it correctly ignores those impossible extreme negative outcomes the other model was factoring in. And this right here is the biggest takeaway of all. The little assumptions that are baked into a financial model, they're not just tiny academic details. The model you choose to believe directly and dramatically changes how you understand risk. And that has very, very real consequences for your money. And that leaves us with one last big question to think about. We just saw how 2 standard, widely used models can give us wildly different answers for the exact same investment. So it really makes you wonder, if our best mathematical tools can disagree this much, what other risks, the ones that are harder to see, might we be missing entirely?